Hey traders, Raghee here. Let's get a quick audio and video check-in for our charts and coffee for Tuesday, December 29. Should be good to go. Great to have you here. Thanks for joining me for yet another episode as we wrap up 2020. All right, so let's get to it. All right, so as always, feel free to type in whatever questions that you might have. We'll go ahead and tackle those. Is tea okay? Absolutely. You know, I was just thinking, I have charts and coffee, but maybe we need a midday T&A, technical analysis session or something. Yeah, I love tea. Access trading, yeah, don't tell anybody. But usually midday, I like a little jasmine green tea and some honey. So great to see everybody. All right. So let's get to it. And Glenn, I like it right off the bat. Let's jump into this. So Glenn asks, is money supply the key driver of the rally? I think there's a couple of things. Glenn, let's go one step beyond the money supply, because tethered to that narrative is the narrative around the central banks. And I'm in that awkward hair stage again. Time to get a haircut. All right. So one of the things that we want to remember, and thank you for the question, Glenn. So this goes back to a topic we discussed yesterday, which was the ABCD macro that is the pillar of understanding a rate of change of growth, inflation, money supply, and monetary policy. So this, I would say that would be part of the narrative. Let's go take a look at this rally we're speaking of. We'll just bring up the S&P here. And I was also going to use the trading view charts because I haven't used these in charts and coffee. I'm a big fan. And many of my tools are available free on the TradingView platform. So taking a look at the S&P here, and I'm just going to minimize this particular indicator right here. Oh, thank you. Coffee has arrived. We're rocking the good old Death Wish coffee today. So good morning, good morning. Okay, so in terms of money supply, I would say the central banks and their V bottom in the balance sheet, which we saw back in August. Now you can track this. These are things that are made publicly available, and you can track this and you'll see the V bottom, the turnaround that we saw in August of last year and 2019. And so I would say that's one of the key drivers. Now, the other part of that, Glenn, and terrific question, is that when the central banks have been keeping rates low, what they're doing in terms of gobbling up the treasuries, mortgage-backed securities, things like that, the things that are part of that ever-growing balance sheet, is they're driving money into corporate debt, which, by the way, they bought via that special treasury purchasing of HYG and JNK. So they're driving capital into corporate debt, and they're driving capital into the equity markets, because if you're looking for any kind of alpha whatsoever, where are you going to go? If you're looking for any kind of return, where are you going to go? So it's almost a good central bank. And I'm not saying that what they're doing is good or bad. We can discuss that another time, right? But a good central bank is a lot like a shepherd dog. It's a German shepherd. It's shepherding the money exactly where it wants to go. So I hope that makes sense. And that's exactly what they're doing. That's exactly what they're doing. All right. Yeah, Alex says the countdown. Yeah, I thought I'd play around with that so you guys aren't waiting until the mic and the camera goes live. All right. And tea is absolutely fine. I'm a big fan of some green tea, no doubt. Hey there, Dan. How you doing, my friend? Excellent state of the market last night. Oh, thank you. So if you guys are tuning in, which you likely are, on either my YouTube or Facebook channel, thank you so much, or on the Simpler Trading YouTube or Facebook channel. Again, thank you. You'll notice on the Facebook, YouTube channel, and I can put this on mine as well if you're watching. I did a state of the market yesterday at 5 p.m. Eastern, and you guys can check that out. The replay is available on Facebook. The replay is available on YouTube. And in that particular state of the market, and this is something that we discussed in the futures room and also in the Sector Secrets Mastery, and that is the seasonal tendencies. Look, I've been getting a lot of questions, gang, about when this market, the equities markets, are going to pull back or roll over or whatever, because a lot of folks are noticing we're pushing to higher highs, and they want to know when might the market pull back in a much more significant way, much more pronounced way, making more of a significant correction. To me, significant is not an 8 exponential moving average pullback or even a 13. It typically begins around a 21 EMA pullback within the context of a double green environment, which we do have. Now, if you notice on TradingView, when I'm looking at double green, while I do not have the trade flags that would be normally sitting up in here, what we have are these. This is the Nasdaq. And I can see that and we can even change. This is something that I've made available to members. I don't know if we're going to make it available to non-members just because supporting it can be a little difficult. But you'll notice, let's see here. I think there's a way that I can change the settings. There we go, style. And instead of these little arrows, I like using the circles. Or you can even use 2 different types of, or even the squares. I think the squares are pretty nice too. So, check that out, see what visually works for you. But I'm going to go. Okay, here we go. So notice this is double green. See the dots that are plotting here? That means that the environment of the 8, 13, 21, and 34 are that double green environment that I talk about so much in this room. Okay, so by the way, speaking of indicators, many of the indicators that I use on TradingView are available free. All you need to do is search Simpler, and you'll notice that my Simpler Trading Darvis 2.0 free, Grab Candles free, Propulsion free. Now, one thing that I'll remind everybody is if you're using the free version, you're limited to 3 indicators. If you're using one of the paid for versions, clearly you have access to more. If you have 3 indicators, what I'd recommend is check out the Salty Propulsion. It'll allow you to put all my propulsion dots on TradingView. I don't know who Salty Propulsion is. They took my work and decided to make it more accessible to the folks on TradingView, and that's cool with me. It's a free tool, and I love sharing this stuff with you guys. So you can check that out on TradingView there. All right, so thank you very much for that, Dan. I appreciate that. And one of the things that I think we'll see, kind of following up on that conversation we had yesterday, again, you guys can check out the replay. And a lot of what is going to determine some of the timing for what I want to do in January, most especially for my stock option and ETF options trading, is take advantage of the pullback that we see somewhere between the 9th to the 17th in terms of the way that I described it is the window dressing that we're seeing, the way in which portfolio managers will dump their losers, pick up more of the outperformers as we go into the end of the year. Just as the name suggests, it's just to make the portfolios look at the end of the year better organized than they maybe really were. Yes, it's a completely deceptive practice. And 1000% it happens. But what also happens is the unwind we see mid to late, mostly mid January, as a lot of those positions are then dumped. And how many of you have seen the way in which January tends to have a little bit of a pullback? And that's something that I want to absolutely take advantage of. Is BABA a good buy? I have zero interest in BABA. I think that was still left up from another time someone had asked me a question about BABA. This is one of those situations where, for those of you that want to take a shot at it, rather than me just tell you no, I don't like, Pamela, thank you for the question. I think it's a very common one. I typically don't like to look at stocks that are not moving with their broader ETF, their broader passive investing narrative. So Pamela, the thing to remember for me here, and the way that I like to approach the market, is that if I'm looking at BABA, rather than making a direct bet on it, I would prefer to play the tide. I would prefer to have exposure to BABA by way of MCHI, by way of perhaps even the FXI, and not play directly BABA, because BABA's drugged these down. This is where understanding the percentage weighting of BABA in the different Chinese ETFs is going to be really important. So you have exposure to BABA, but you're not only looking at BABA. I'm not a big fan right now. I think that there are a lot of other better double green relative outperformers in, including KWEB, by the way. I showed you FXI, MCHI, also KWEB. And by the way, what we just did there, and thank you for the question, is really the process by which we want to use these ETFs as pre-curated watch lists, where we can go in and very easily and systematically, using a process of relative outperformance, pluck out those names and those ETFs that we want exposure to, that we want to take advantage of. So thank you very much for the question. So no, for now, I'd rather play the tide and not the individual boat. So absolutely. Oolong, I'm a oolong tea. Absolutely. I'm a fan. I am absolutely a fan. Hey there, Trisha. Citrus mint. I'm all for that too. All right. Question from Jeffrey, who asks, good morning. Do I trade Forex the same as everything else? Double green pullbacks on a daily. Jeffrey, yes and no. When I'm getting into currency trading, the thing to remember about currency trading is that now we're talking about pairs trading. You're trading two of something, and the contrast between the two is very important. And, we've talked about contrast in the futures room. We've talked about currency plays, and I think we touched on this yesterday too a bit. And that is focusing on a longer term look back. So usually if I'm going to be looking at longer term trends in currencies, it'll be on a daily time frame, but that's the same for stocks and ETFs as well. What I want to do is I want to find contrast. I want to find the weak name or the weak names, and I want to short those, sell those against the strong names, right? That chasm between the two currencies there, that's contrast, right? And that's what I want to take advantage of. So having said that, usually your trends are going to come from contrast and that might be verbiage. It's a little different than what you've heard other Forex traders talk about, because pairs contrast, individual currency contrast is absolutely what makes the Forex market as amazing as it is. Imagine an engine firing on both cylinders. Now, as far as pullbacks go, one thing I do in Forex, probably in a more emphasized way, and I did a class called Forex Freedom, I believe it was early January of this year. So it feels like forever ago, but January of this year, I did a class called Forex Freedom, which you can find at the simplertrading.com website. And I use the daily price movement ranges quite a bit. All right. I use those quite a bit, which is the historical look back on volatility and how many pips we typically see in terms of movement in a particular pair. So that really, in many ways, is probably the most I will rely on historical volatility in any market, and that's in the Forex. And so a lot of traders are usually kind of surprised that once I've determined the structure of the market, and you can do this in stocks and ETFs too, but once I've determined the structure of the market, I will heavily rely on those historical price movement ranges. And to the point where the chart itself almost comes in second. So Jeffrey, that's very similar, but that's a huge distinction between the two. All right, so thank you for the question. All right, Jonathan asks, yesterday I mentioned waiting for a retracement to the 8 SMA. What would make me feel better getting there? Well, number one, the 8 SMA has to be in play. It's not always in play in a market. I use the propulsion tool to confirm that the 8 is valid. So for example, and I don't know which market, Jonathan, remind me if you will, which market you're referring to, but this applies to anything. If the red dots are not there, there's no 8 to respond to. And also, if a market's gone parabolic, look, there's a way to momentum trade. There's a way, especially in the context of a trend. I don't mean momentum trading breakouts, which is just breakout, breakdown trading out of a consolidation. There is a way to momentum trade. And the way to momentum trade, sort of to your point, is to understand if an 8 or 13 exponential would be valid. And also whether or not the market's gone accelerated or parabolic in a way that has exceeded the daily price movement range or even an average true range. You know, I have a specific tool I use for average true range too in those markets that I don't have a historical price movement range to rely upon. So it would really depend on that, Jonathan, if we've accelerated or gone parabolic in that way, and the red dots of the 8 EMA propulsion have really got to validate that. That's a big part of that. Let's see. If we are long quite a few double green markets, hey there, Rishi, what is a good option to hedge for a pullback? I don't hedge, Rishi. If you're long double green markets in the way that I discuss here in Charts and Coffee, in the way that I teach in Sector Secrets and things like that, I don't hedge because, well, one, I'm a trader. My hedge is really a combination of taking profits and scaling out of positions while I can and not when I have to, and a stop loss. So I'm not a big advocate of a hedge at all. I think hedges are one of those things that make us all feel better about having bought at higher highs where we're most vulnerable and where I will not be engaged in the market. And you guys know in these Charts and Coffee, I'll give you guys a straight up on what I do. I think hedging, generally speaking, is a colossal waste of money. I seldom meet people in the trading space, right? I'm not talking about portfolios, right? I'm talking trading specifically, right? If we're talking capital allocation for longer term time horizon, completely different narrative. But I'm bringing up Starbucks here because we're long Starbucks in Sector Secrets Mastery. I'm long Coke, right? These are two of our recent buys. Am I going to hedge these positions? Here's why I won't. And even more important, and thank you, Rishi, for the question. Thank you so much. I won't, and I don't have to. Hedging is very much contingent on where you're long from and at what levels you're able to scale out. Okay, really important here again before you start arbitrarily hedging markets. A lot of time hedges are a tactic and a byproduct of chasing a market higher, where you sort of have to, because again, you're out on a limb, you're in a vulnerable spot. We're long from here. All right, we're taking profit already. Do I have to hedge that position? I don't. I've done the smartest thing I can do as a trader, reduce my size while taking a profit and moving to a break even. And that, my friends, is why I don't have to hedge. And thank you so much for the question. It's just not something I really feel, if you're a trend following pullback trader and not chasing momentum higher, I'm not forced to put that type of, airbag on my position, right? So thank you very much. And so I hope that was helpful. I hope that makes sense. That's a question I get a lot of. All right. And I just want to let you guys know we're here every day, Monday through Friday, 9 to 9:20. I'm going to head off into the Simpler Futures room, take a look at some day trades. We had some folks asking, do we day trade in the futures room? Absolutely. I'm off to go do that now. Thank you, as always, for all your questions. I'll go take a look at the comments a little bit later on today. And I'll see you guys tomorrow, 9 a.m. Be good to each other, gang. Take care.